Okay, in this section, what we learned was how to refine your trading. Really dynamic stuff here at the end of this series. Scott mentioned confluence. Confluence is just the equilibrium meeting at approximately the same levels on different time frames. So if you have a daily, you have a 50% equilibrium on the daily, and you're doing a equilibrium on the H1, and they look like they're about at the same level. That is confluence. Or you could be doing it on a monthly and a daily. So if you have a 50% equilibrium on the monthly, or a quadrant on the monthly that has an equilibrium and it's also on the daily at about approximately the same level, that is confluence. So there's a little bit more, it adds a little bit more to your analysis. So you want to see if they're very, very close. It might have special significance if it's prices closing over that confluence or closing under that confluence. The daily chart is the deciding factor for entry and exits. Shorter time frames are chaotic. Prices are chaotic. They're based on chaos theory. Is that as we mentioned earlier, prices on a lot of different time frames are self-similar, which means that they are a fractal. And you might be prone to impulsive behavior on shorter time frames because you see prices moving sometimes very, very quickly, and you want to jump into a position, and that's the wrong thing to do. Hourly charts, however, may be used to refine your entry and exits. So we dig down on the H1 chart. We start to look for clues and potential price reversals. And the example that Scott used was really, really good. It can be used. You can use Wyckoff's concept of accumulation, spring, markup, and distribution in an uptrend. Distribution, spring, markdown, and accumulation in a downtrend. He also looks for lower time frames for what he calls a Quasimodo. That's a relatively new technical analysis term, but it's basically inverse head and shoulders patterns at a low and a head and shoulder pattern at a top in traditional technical analysis. So you can go, if you're not familiar with the head and shoulders pattern, you can go and look that up. It's very easy to find. Or if you have Thomas Bulkowski's Encyclopedia of Chart Patterns, he documents that very, very well. These typically will indicate a potential intermediate term low or high on the H1 charts. When price forms the Quasimodo pattern, watch for a pullback or on a previous breakout of the pattern to enter a position on the long side, or if it's at the top, if it's a head and shoulders pattern, Quasimodo pattern, at the top of a very large rally, look for a rally up to that, what they call the neckline of the head and shoulders pattern. That's a pretty good entry point for a short position. To be successful, you need to find a system that works for you and your personality and your trading style. Remember to keep your trading simple, follow good money management, learn one style of trading. And this, I prefer this style of trading. I don't like to trade 5-minute charts, 15-minute charts, 20-minute charts. I don't like those short-term patterns. They are profitable for a lot of people, but I prefer, maybe for a lot of different reasons, but I'm very active in my business, and I have a lot of responsibilities, so I tend to like the longer term, not longer term, but I do like the swing trades. So I like the trades that I can get in and stay in for a day or two, and then take my time entering and take my time and exiting those positions. I feel for my personality, it's a lot easier to trade those. I can be patient, I can wait for the right setups, and then I can enter those positions. And I like the larger swings that take place over a day or two or three or four or longer, rather than quick in and out positions, at least for me. So I like those swing trades very, very much. But you need to find out what your trading style is like, what you feel most comfortable doing. Make sure you always use good money management. So you want to be able to place your stops in good positions, typically below, after you see a close above equilibrium on a long position. You want to take a position on when the next pullback happens, and then you want to look for the lows below that to enter a stop. And you're not always going to be successful. There may be some reasons why prices will pull back and take you out of your stops, but that's what stops are for. You're not going to win every single trade, but using this system, or price is everything, is going to give you a definite advantage, an edge in the market, and that's really what we're trying to do here, is give you an edge in the market. Everybody needs an edge. If you don't have an edge, you're going to fail more often than you succeed. And the goal in trading is to win more often than you fail, and to win larger amounts of money on those winning trades. Even if you only have 51% winners, you have a 1% edge in the market, and you can be successful with a 1% edge. All right, I hope this was very, very helpful for you. I'm going to be doing a number of follow-up videos, and I will add those to this course. But I appreciate your time. I appreciate everything that the time you've taken to go through this course. If you have any questions whatsoever, you can contact us with the support email that's been provided to you, and I wish you all the best.